So is this similar to shorting a stock?
Well, we got to be careful with that, right? Shorting stock is an actual position, but the sentiment of being bearish on a stock by buying a put, you can create a position that potentially profits if the stock goes down.
Hi, I'm Denver.
I'm Desiree. Wait a minute.
I'm Desiree.
I'm Denver.
Welcome to Options Trading Essentials, a video series dedicated to teaching you the ins and outs of options trading. In this episode, we'll pick up right where we left off in the previous video to talk about put options.
That's right. The good news is, if you understand how call options work, you can generally figure out put options too. That's because they're essentially mirror images of each other.
So up is down?
And left is right?
Sweet. And if you need a refresher on call options, just check out our last video here.
Just as we did with call options, in this video, we'll explain what a put option is, how it works for buyers and sellers, and later on, Kendall and Obi will identify when a put option is in, at, or out of the money. But first, Desiree, could you tell us what a put option is? Like right now.
Okay.
Okay.
In a bit.
All right.
Okay, here we go. A put option is a contract that allows the buyer to sell 100 shares of the underlying stock at the strike price on or before the expiration date. Many investors use put options as a form of protection against losses on their stock portfolio, kind of like insurance. You pay a premium to buy a put option, which gives you the right to sell at a specific price, on or before expiration. Remember, for every buyer of a put option, there is a seller. The seller not only receives the option premium paid by the buyer, but also agrees to take the opposite side of the trade. In other words, the seller is taking on the obligation to potentially buy 100 shares of the underlying stock at the strike price at any point on or before the expiration of the contract. One last thing. Buyers of put options are typically bearish. They want the underlying stock to go down. Meanwhile, sellers of put options are typically bullish. They're hoping the price of the underlying stock goes up. Obi, break it down for us.
All right, let's take a look at a put option example. Here I've got the XYZ October 22nd, 2021 75 put. And this option for this example, we'll just say, has a premium of $3. So that's our premium, which is the cost of the option. And so what happens between buyer and seller? As the buyer, we are paying that premium price of $3. But once again, of course, every option controls 100 shares of stock. So we take the premium of 3 times 100, which is the underlying shares that the contract controls, and we are paying the seller of that put option $3. 3 times 100, they are collecting $300. And in exchange for selling us that put option, the seller are obligated to buy XYZ stock at $75 by the expiration date of 10/22/21. So just to recap, the buyer is paying $300 to the seller has obligations because we now have the right to sell stock at $75, which is the strike price, on or before October 22nd, 2021, which is our expiration. And so our buyer has paid $300 and our seller has collected $300. Now, what happens next? Just like in our previous video where we introduced the concept of in-the-money call options and out-of-the-money call options, let's talk about when a put option is in or out of the money. So here we have XYZ, our imaginary stock, and let's imagine that stock has been kind of trending downwards, and now here we are at the current price of $80 per share, and this is our current date of today or now. Now, the buyer of the put option, they typically want this stock to go down in value because they're bearish. The seller of the put option, they would prefer that the stock stays where it's at or even goes up in value because then they can keep that premium. So when does the option become in or out of the money as a put? Well, let's draw on our chart our $75 strike price. I'm just gonna create this line across. And then of course we need to highlight our expiration date. So there's our expiration date of 10/22/21. label that expiration. If the stock goes down in value and continues to decline and goes below our strike price of 75, this option becomes in the money. And why is it in the money? Well, remember, when we own a put option, we have the right to sell at the strike price. And just like anything else, we want to sell things at a high price, higher than when we buy it, and therefore potentially profit. So in theory, if the stock in the open market is trading for $70, but we have the right to sell it at 75, we can sell the stock at a premium or a higher price than where it's currently trading in the market. In this case, this option would be in the money by $5. So if we exercise our right to sell the stock at 75, with the stock trading at 70, we would have a potential value in that option of $5 per share. But remember, we paid $3 for this option, so we take that $5 and subtract the $3 in premium we paid, and there we would have $2 built in potential profit to the underlying short stock position. Or if we own shares and sold shares that we own, we would be able to sell it at a $5 premium to the current market price. Now, what happens if the stock goes up? Well, if the stock goes up and stays at or above our strike price, this option would be out of the money. Why? Well, if the stock's trading at 90 in the open market and we have the right to sell it at 75, I would rather sell those shares at 90 instead of 75. So in that case, we wouldn't exercise our rights to sell the stock at 75. And so if the stock continued to climb and stay above our $75 strike price, this option at expiration would expire worthless. Why? Well, we wouldn't use the option. It wouldn't have any built-in value. The option wouldn't be in the money. Instead, it would be out of the money and at expiration expire worthless.
Think of a put option like car insurance. You pay your insurance company a premium, and in exchange, they insure you against damages to your car. A put option is kind of like this. Instead of owning a car, you own stock. And instead of an accident, you're worried that the stock price might go down. Just like an insurance premium, you have to pay to buy a put option, which gives you the right to sell at a specific price on or before expiration, which can potentially limit losses. It's this reason why some will say when you buy a put on a stock that you own, you're buying protection, because you're attempting to protect against losses for that particular stock within your portfolio. Just keep in mind, unlike car insurance, you can buy a put option on a stock that you do not own, taking a bearish stance and hoping to profit if the stock goes down in price.
In the last episode, we covered in the money, out of the money, and at the money for call options. Today, we're gonna go over put options. Denver, will you walk us through the options chain?
Absolutely. It is going down. How about we do Twitter?
Yeah, Twitter.
All right, awesome. So, I'm gonna go, we're on the home screen, we're gonna go to search. I'm gonna look, all right, TWIT, there it is. All right, fantastic, select it, trade options on the Discover page. We're gonna select the August 20th expiration date. So automatically, by default, we're on buy and we're on call. We wanna switch that over to puts. Okay, there we go. Now we can see the share price at 62.62. We see the $63 above that, $62.50 below that. I need some context here. Give me some info, guys.
Yeah, absolutely. So not too different from the call side of things, but you have to remember when you own a put contract, typically you want the underlying stock to go down in value. You are bearish on it. So when you own that put, if the underlying share price has gone below the strike price of your contract, that contract is deemed in the money. If the share price is at the strike price of your contract, it's deemed at the money. And then the opposite end, if the share price is above the strike price of your contract, that contract is deemed out of the money. So kind of similar to calls, but the opposite end of the spectrum. Now, when we're looking at the chain specifically on Robinhood here, we have all of the contracts outlined for the August 20th, and we have the share price in the middle. So everything below that share price is deemed out of the money right now. You have the 62.50 put, but Twitter is trading at 62.62, which is above 62.50. So that 62.50 and everything below it is deemed out of the money, whereas everything above that share price on this chain is deemed in the money.
So is this similar to shorting a stock?
Well, we got to be careful with that, right? So as we talked in episode 2, shorting stock is an actual position, right? You borrow shares from your broker, you sell them, you have limited downside profit potential, unlimited upside risk potential when you short stock. But the thing to take away is when you short stock, you're bearish, right? You want the stock to go down when you have a short stock position. You can't necessarily do that at Robinhood, right? We don't at this time allow people to have a short stock position, but the sentiment of being bearish on a stock by buying a put, you can create a position that potentially profits if the stock goes down. So it's a way to be bearish without having a short stock position.
Oh, okay. So not exactly shorting a stock. You just think the price of the stock will go down.
You have a similar sentiment to people that may short the stock.
I see. But with a put, your losses are capped, right?
Potentially, yes. Generally speaking, the most you can theoretically lose when you purchase an option is what you paid in premium. So if we look back at the option chain, if, with Twitter trading at 62.62 right now, if we, for example, had a bearish opinion on the stock, and granted, we're looking at options that expire a few days from now, so it's that first expiration. If we thought Twitter was going to get below, say, $62 by the end of the week, and we wanted to buy that 62 put, then yes, we would have that bearish sentiment, and theoretically, the most we could lose is that 54-cent premium that we pay for the option. Whereas if someone was shorting Twitter, Twitter could go up forever, so they theoretically have unlimited risk to the upside.
Got it.
And the thing that I want to point out, we talked about this a lot in the last episode about in-the-money call options and why would someone exercise an in-the-money option versus not want to exercise an out-of-the-money call option, right? We did the quick little math, right? Well, let's do that same thing here, right? Let's imagine we all own Twitter. I'm just going to pick a random price. Let's say we own Twitter at $65 a share, okay? With the stock trading at 62.62, we would have, kind of an unrealized loss at the moment on the stock of about, we'll say $2.50, right? So if we went out and we bought that 62 put as protection against our stock, right? We would only want to sell Twitter at 62 if Twitter dropped, right? If Twitter went up, would we exercise our right to sell at 62 if it was trading at, say, like $100 a share?
No.
No, right? We would only want to exercise that if, say, Twitter went down to, $40. We have the right to sell it at 62. That would be $22 higher than where it was trading in the market. And that is that in-the-money amount. So that's that same math that we want to do here when we're thinking about puts.
All right.
I see. So it is the flip side of a call.
We mentioned this, right? It's the inverse. It's the flip side. Up is down, left is right.
Right.
It's basically the two sides of the same coin.
Yeah. Okay. I feel like I've learned a lot about puts and calls. Do you have any final thoughts on put options specifically?
Yeah.
As opposed to call options?
Generally speaking, put options tend to be the second thing people learn in options. It's just sort of a natural progression, whether you pick up an options textbook or, maybe you're fortunate enough to be in some type of a class setting. Usually calls are taught first and puts are taught second. And people tend to grasp calls a little bit easier because naturally most people understand what it means to buy shares of a stock.
Yeah.
Right? But when we get to the put side and it's like, why would I pay to have the right to sell something? It takes a little more in your brain to kind of make all of that make sense.
Yeah, that's right.
So guys, is it one or the other? Or can you have both? Can you have both a call and a put?
You can. It can get a little complicated, though. We might touch on that in future episodes for sure. But you can have both a call and a put, but it's a little bit more of an advanced strategy. So we really just want to make sure that you understand the basics of a call and a put option, how to read the chain, in the money, out of the money, and then we can just build on that foundational knowledge as we progress.
Yeah, and you're gonna find as we get into strategies later on in the series, you can do so many different things with the way you build an options position.
You're blowing my mind.
Yeah.
Oh, blowing my mind.
Just scratching the surface here.
Yes, definitely.
Yeah.
That's so much information. Now we know about call options. Now we know about put options. There's a lot to go over.
And we're only getting started. The next few episodes, we're gonna start getting into options pricing. We're gonna talk a little bit about expirations and exercise and assignment. And as Kendall said, we gotta get the basics down so that we can get to the fun stuff later.
Definitely.
Well, let's become pros on the basics and see where we go from there.
On the next, Options Trading Essentials.
The expiration date is the last day that the options contract can be bought, sold, or exercised.
There's quarterly expirations as well as monthlies and sometimes weekly.
As a trader, you need to be hyper aware of your expiration date.
Time is money.
Thanks for watching the video. If you enjoyed this episode, smash that like button and leave a comment. And don't forget to subscribe to the channel to get alerted when new episodes become available. Remember, options involve risk and are not suitable for all investors. Before trading, check out the link below in the description.